A RAK ICC Restricted Purpose Company or RPC is a special purpose vehicle with its permitted activities written into its constitutional documents. It can hold a specific asset, complete a defined transaction, or isolate one project from the rest of the family or corporate group. My name is Shiraz Wahid and I'm the co-founder at Liabilities Wealth. And in this video, I'm going to explain how a RAK ICC Restricted Purpose Company works, where it is used, how it differs from a normal holding company, and how it is compared with SPV structures available in DIFC and ADGM. We will also cover governance, tax, banking, and how RPC can sit under a foundation or a wider wealth structure. A RAK ICC Restricted Purpose Company is a company limited by shares that is used as a special purpose vehicle. Its memorandum must state that it is a restricted purpose company and clearly identify its permitted activities. Unlike a normal company, which usually has broad corporate capacity, an RPC is limited to activities written into its memorandum. This gives the banks, investors, lenders, trustee, and business partners a clear view of what the company can do. The wording must be drafted carefully. If the purpose is too broad, the restriction has limited value. If it is too narrow, the company may struggle to acquire, finance, manage, or dispose of assets. The RPC has shareholders, directors, a registered office, and a RAK ICC registered agent. The shareholders own the company while the company owns the assets or enters into the transaction. The directors manage the vehicle and must keep its activities within the stated purpose. A family foundation could own the RPC shares while the RPC holds one investment, one property interest, intellectual property, or shares into a joint venture. This separates the assets from the individuals who benefit from the wider structure. The RPC status is selected when the company is incorporated, continued, or registered. A normal RAK ICC company cannot simply convert into an RPC later. Its purpose may be amended through the required process, but the company cannot remove its restricted status. The intended role should therefore be settled before the formation of the RPC. RPC is useful where one asset or transaction needs its own legal container. It may hold shares in a private company or joint venture interest, intellectual property, financing rights, investment assets, or project-specific interest. It can also be used in acquisition structures, secure financing, succession planning, or family investment arrangements, especially where the company's role must remain limited. A family with several unrelated investments may use separate RPCs for selected assets rather than placing everything inside one holding company. Exposure linked to one investment should then remain within the company that owns it, subject to guarantees, security, misconduct, and facts of the case. The RPC may also simplify a future sale or restructuring because one vehicle can be transferred or financed without changing the ownership of every other asset. It is generally suited to passive or transaction-focused activity. If the business needs employees, customers, contracts, regular sales, or active services, a licensed operating company will usually be more suitable rather than RPC. Now, when it comes to the legal limits, the RPC has a separate legal personality. It owns its assets and incur its liabilities, while the shareholders own shares in the company rather than the underlying asset directly. This can help isolate financial and legal exposure, but the separation is not absolute. Wider exposure may arise where a shareholder or parent gives guarantees, pledges other assets, mixed funds, or use the company improperly. The restricted purpose adds another layer of control. Directors and counterparties should confirm that every major agreement falls within the memorandum. Incorporation also does not give the RPC automatic permission to own regulated assets, provide financial services, trade inside the UAE, or avoid rules of another jurisdiction. Property registries, lenders, regulators, and foreign authorities may impose separate requirements. Now, let us compare RPC with a standard holding company. A standard holding company is usually better where broad flexibility is required. It can acquire and sell different subsidiaries, receive dividends, reorganize investments, and enter new opportunities without changing a narrow purpose each time. An RPC is more suitable where the restriction itself provides value. Investors may want confirmation that the company cannot begin unrelated activities. A lender may want the borrower to own only the financed assets. Family members may want one investment separated from the main family holding company. The two structures can also work together. A holding company owns several operating and investment companies, while RPC is used for one project or one ring-fenced asset. Within this structure, a foundation can also own the holding company and the RPC direct. The holding company then manages broad corporate ownership. The RPC performs limited role and the foundation manages succession and family governance. An effective RPC requires more than a certificate of incorporation. The memorandum must state the purpose accurately and the articles should support the intended control management. Shareholder agreements, financing documents, security agreements, and the bylaws of the foundation should use consistent terms. Directors needs clear authority for acquisition, disposal, borrowing, distribution, and amendment of the purpose. The company must maintain a registered agent and keep the required corporate, beneficial ownership, transaction, and accounting records. Banks and counterparties would normally ask for the ownership chart, source of funds, and expected transactions, as well as ultimate beneficial owner details. The restricted nature of the company can make explanation clearer, but it does not reduce anti-money laundering requirements, sanctions, reportings, or due diligence requirements. Banking still depends on asset, the ownership profile, the parties involved, and the evidence supporting the expected flow of funds. Restricted or passive status does not create an automatic tax exemption. A UAE incorporated company must be reviewed under the corporate tax framework, including registration, filing taxable income, exemption, transfer pricing, and record keeping. The outcome depends on the income earned, the location of the assets, the parties involved, and where the company is managed. A company holding shares may have different positions from one receiving interest, royalties, property income, or gains from the asset sales. International tax rules also matters. The residency and domicile of the shareholders, founders, beneficiaries, and directors may create reporting, controlled foreign company, as well as inheritance or anti-avoidance consequences outside the UAE. Tax advice should therefore cover every jurisdiction connected to the owner, decision maker, income, and the assets. Now let us compare RAK ICC's RPC with other jurisdictions including DIFC and ADGM. RAK ICC, DIFC, and ADGM all provide vehicles used for special purpose, but their framework is different. In DIFC, the SPV is generally known as the prescribed company. It is a passive holding vehicle and cannot conduct operational or commercial activities or employ staff. Access is linked to qualifying applicants and qualifying purposes, including certain GCC assets, structured financing, intellectual property, and other approved use cases. DIFC also operates under its own common law framework and its own codes. Now, in ADGM, an SPV is also a passive holding company used to ring-fence assets and liabilities. It cannot conduct operational business or employ staff, and the applicant must demonstrate an appropriate connection to ADGM, the UAE, or the GCC. This may come through regional ownership, a regional asset, or a transaction with regional links. Non-exempt ADGM SPVs generally require an ADGM licensed company service provider, and ADGM also operates within its own common law framework and codes. The RAK ICC's RPC places its restrictions directly into the company's memorandum, and it is often considered for international holding, private wealth, joint venture, or project structures outside of the financial center model. The choice should depend on the asset location, the counterparties, investor expectations, governing law preferences, and ongoing administration. For a private family, the RPC normally sits below the main succession and governance layer. A RAK ICC foundation or DIFC or ADGM foundation or a suitable trust may own the shares of the RAK RPC, while the RPC holds the selected assets or transaction. The ownership layer sets the long-term rules for control, incapacity, succession, and distributions. The RPC isolates the assets and keeps its activity narrow. Before forming one, the assets should be mapped and the expected transactions should be listed, as well as the memorandum should cover the practical actions needed during the life of the structure. The relevant banks, registries, lenders, and foreign advisors should also confirm that they will recognize and accept the vehicle. An RPC works best where its limited purpose is commercially useful and consistently followed. Where broad trading flexibility is required, ordinary company or licensed operating entity will normally be a better fit. So if you want our help and would like to explore whether this structure suits your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.